Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I'm Ryan Nauman, the market strategist here at Zephyr. Now, following the aftermath of the great financial crisis, banks withdrew from certain lending areas due to stricter regulations, and really the rise of private equity, which resulted in an increase in demand for tailored debt financing. Well, I have on an industry expert and the perfect guest to talk all things private credit and what it means for financial advisors as they build investment portfolios. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and get started and move on to the star of the show. I'd like to give a very warm welcome to Robert Stark. Robert is the CEO of Nomura Capital Management. Robert, thank you so much for coming on. It's an honor to have you on. I'm really excited about this conversation. Really great subject with private credit. Can you please tell us a little bit more about yourself and Nomura Capital Management?
Yeah, sure. Ryan, first of all, thank you so much for having me on your show. I'm a huge fan, big follower, so grateful to be here. Hopefully today will be interesting for your audience. Needless to say that I'm all in for private credit. A little bit on my background. Your listeners might wonder where the funny accent is from. I'm originally from Germany. My wife is German, and so that explains the funny accent. My 3 children were all born here. They're already starting to make fun of my accent. I
I love it. I love it, Robert. I don't think it's funny. I think it's great.
Maybe a little bit of background on Nomura. Nomura is a Japanese financial institution. Our firm was founded 100 years ago, actually this year. We've always been Nomura, always the same firm. We are one of the largest wealth managers in Japan. We serve more than 5 million households. That's around 30% of our revenues globally. We have a pretty sizable wholesale banking business. So think investment banking, sales and trading activities. That's 60% of our firm's revenues. And then the remaining 10% is asset management. So globally, Nomura manages around 600 billion in assets. And that brings us to here to the US. The US actually is our largest market outside of Japan, Japan being our home market.
Fantastic. There's a great backdrop about Nomura yourself. Thank you for being a follower and avid watcher of the podcast. Really appreciate it. It's great. And our audience is going to love this conversation about private credit. Private credit, why did you really, is there something that drew you to private credit, or is there something about private credit that was like, you know what, this is really fascinating. I want to be an expert in this area. What was it that drew you to private credit?
It was definitely an evolution. Some previous areas or firms that I worked with were very heavy leaning towards the public markets, but they weren't necessarily bringing that into a more sort of retail-oriented audience. And so I eventually ended up in a private credit firm that did this, but I thought more to be done, especially in the RA space. And on the RA space, I think the main point here is that we, as the asset manager, we are also an RA. And so our clients are like, we are RAs, they're RAs, whether it's a $400 million shop that only does alts, whether it's a $10 billion shop that only does ETFs, like it doesn't matter. You meet one RA, you've met one RA. And what I did find very appealing was before we started our endeavor here inside Nomura, my partner and I, we actually interviewed 50 RAs and tried to understand how were they allocating to private credit in particular, what were they missing? And we realized that most RAs actually, if they were allocating into private credit, it was all direct lending. And so to them, they thought private credit equals direct lending. When you think about BDCs and other type of funds that are out there, whether it's drawdown or in other structures, they were all focused predominantly on direct lending, which ties back into what you said at the beginning of this podcast, like the whole wave we saw in private equity. Obviously, direct lending asset managers stepped in and were quite aggressively competing with the banks on the leveraged side of things. And so you then tie this back to our conversations with the RAs. We realized when they say private credit, they actually mean direct lending. And to
Okay.
us, private credit is so much more than just direct lending. And that's how the journey started a couple of years ago. I'm happy to go into more detail what we see private credit morphing into.
Yeah, that's fantastic, Robert. Thank you for that history and backdrop. About that, about direct lending or direct credit versus private credit that you talk about some of these RIs do. What's the difference? Is there maybe advantages to one or the other? Is there a benefit for all those other RIAs that are looking to get private credit? Why you would do private credit versus direct lending?
Yeah, maybe for the audience, private credit obviously is an area. It typically refers to loans that are made to borrowers that are originated outside of the traditional banking or the what we call the like core public fixed income markets, right? So the loans are more floating rate in nature. They don't trade publicly on an exchange. They're bilaterally negotiated between borrower and lender. And they typically cut across a whole variety of industries. And loan to loan, the things like collateral terms, etc., can vary greatly. But that's also specifically what the borrower is appreciating. There's confidentiality of information. It's not all public. So there's a whole variety of factors for why private credit can actually be quite appealing to the borrowers. To the investors, it really offers an opportunity to complement traditional portfolios, whether it's taking away some of the exposure from the public fixed income side or doing both from the public fixed income and the public equity side. And what it might offer you is enhanced income generation, lower volatility, potential for total return enhancement, and diversification because it's much broader spectrum in terms of the underlying sectors and companies that you provide loans to.
Fantastic. And Zephyr, I've used Zephyr to create some research recently about alternatives and how they perform in different market environments. The Fed's cutting rates, but one thing too with private, and you mentioned it, private credit is typically floating rate. So I'm assuming through that research, private credit does well in rising interest rate environment, right? Because it's floating rate. In the other environments, they tend to perform well in.
It's also on the when rates are coming down, it's the same thing because you typically negotiate certain floors in the individual loan agreements. That is the protection, whether it goes up or down, quite frankly. I think what is more relevant, the way we look at this is you should get a certain spread above the public markets. And that spread varies, obviously. So if you just take the spread to, let's say, high yield, you would hope that there's at least like a over a cycle, a 200 to 400 basis point spread over high yields. Obviously, that spread is even higher if you compare it to investment grade, but even compared to the syndicated leveraged loan markets, there's still a very healthy spread there. And then actually, if you then go into the private credit side of things, direct lending and then asset-based lending, real estate lending, especially finance, which are some of the other areas within private credit, you get even higher spreads compared to the direct lending side of things, which is, by the way, also why many funds, rightly, that are more exposed to direct lending have some form of leverage attached to them. You don't necessarily need that or see more of that in pure asset-based or real estate lending type vehicles. And the last thing I will mention here is, so I said earlier that people think private credit equals direct lending. Direct lending is estimated to be around 2 trillion in size. We believe the total private credit market or the opportunity for it is probably 10, 20 times as large. If, for example, asset-based lending alone and real estate lending combined is somewhere between 15 to 20 trillion dollars easily. Whether you have commercial real estate, residential real estate, and some of the other sectors within, especially finance, like accounts receivables, for example, litigation finance, royalties, be it music, healthcare related streams of future cash flows that you can lend against. So I think what I want to convey is people should think much broader in private credit. And when they then think about how do I access or invest into this asset class, diversification, we believe, is absolutely key. And diversification comes first and foremost from the different sectors within the private credit market that I would like to get exposure to. So when you invest with us, we like to give you that diversification by having you accessing direct lending, of course, but more importantly, asset-based lending, real estate lending, and specialty finance. And that is something I want to go back to the 50 interviews we did with the RAs. That is, if you want to say, that was the epiphany that we had, because my view was going into these interviews was they want very RAs, be it the founder, the CIO, depending on the size of the firm, they wanted very targeted exposure. Give me aircraft leasing only, or give me your music royalties, but nothing else. Similar to how many advisors consume ETFs, for example. To our surprise, it was the exact opposite. We heard loud and clear that most firms wanted to actually not have that, but rather have a much broader, diversified exposure into the private credit market. So what it really resonated well with them when we said, what if there is a strategy that gives you access across the board of private credit, and not only to direct lending or not only to specialty finance? And that to me told me that there's a real opportunity, there's a real client need, there's a demand. And at the time, there was nothing available that would fit or solve for that demand. And that's when we got to work and build out our business here at Nomura.
Yeah, Robert, that's fantastic. I knew I was going to learn a lot here, and I just learned something. When I think of private equity, private equity is made up of all these different sleeves. You got secondaries, you got venture capital. I guess in private credit, I didn't realize there was a lot of different sleeves there too. There's asset-based lending, but all the others that you mentioned, and it's hard now to get a real diversified portfolio market your traditional asset classes, stocks, traditional bonds, international, foreign. Their correlations have increased, especially during times of crisis when you really need correlation or lower correlation and diversification. So it's good to know there's other subsets. It's just not a big group private credit. There's different ways to diversify.
That's absolutely right. And if you just take asset-based lending as an example, you typically have some form of collateralized assets, and they can be hard assets. Think real estate, whether it's commercial, multifamily, residential, or whether it's like equipment, for example, machineries, or things like account receivables. Those are just like different ways of how to express a view that there's an asset that you can collateralize, that you can lend against in a private transaction, and there's an inherent illiquidity that comes with it. There's a complexity with it, and there's a confidentiality piece with it. And if you put it all together, that can create a pretty attractive return stream to investors that are interested in gaining exposure into the private credit markets.
Yeah, interesting. Let's talk, since you brought up talking asset-based lending. What's your view on asset-based lending moving forward? Is a lot of opportunities in that space? We talk a lot about, I think people know asset-backed securities and mortgage-backed securities. What's your view moving forward?
Yeah, we see plenty of opportunities in this space. Just to give you some ideas, like real estate is a huge opportunity, commercial real estate, HELOCs, residential transitional loans called RTLs. We see a ton of opportunities in specialty finance areas, especially leasing, receivables financing, NAV financing, and also royalties. And on the corporate side, non-sponsor backed solutions to clients that don't want to go, that are too small, they don't want to go the traditional sponsor backed route, or they just are under the radar. of like typical transactional relationships, which by default have to be larger in size. And so those are just some areas. If I were to focus on one in particular, it's probably the real estate side, especially RTLs. That is definitely, if you think of the shortage we have on the housing side, um, interest rates have started to come down, as we have seen. So developers typically some form of bridge financing solution. They own the land or they only own the building. They need to do a renovation or put the houses in. And there's a shortage of financing, borrowing capacity or lending capacity rather for that. That's where someone like us can step in. What is also attractive with these type of loans is the maturity is much shorter, or the duration of the loan is typically somewhere between 18 to 36 months, as opposed to more longer dated loans that you have on the corporate side. And so that is an area that we see significant demand, and we don't think that's going to dry up anytime soon. Here, obviously, it's all about having the relationships in the local market. So origination is absolutely key. And we have built a network of originators in the specific markets. We don't cover all markets, quite the contrary, we're really focused. And so that's something that I'm very bullish on. And I think you're going to see a lot more. And that's just one example. But the point here is you can't do everything. That's not, in fact, that's not how we operate as a firm. If you look at our on our wholesale banking side of things, in fact, we are much more targeted and specialized in what we offer to our clients. Securitized products, for example, equity derivatives. We don't have cash equities, for example. So that mentality is also one that we apply here on the asset management side. So we are much more specialty focused as opposed to a sort of very broad provider.
Yeah, I feel as if that's a big advantage to asset management firms specialize in something that you're really good in versus just spreading yourself out so wide. Go deep into an industry or sector and be the industry leader there, like you're with private credit. Let's talk about real estate again. It's an opportunity. You said mortgage rates are coming down a little bit. In your shoe, you're the investor, you're the one lending money, private credit, lending money to whether it's the developers or that area. You talk about interest. How does interest rates impact you as the investor? Into is falling interest rates good for you, or do you prefer the higher interest rates or stable, should I say?
To us, it doesn't really matter, quite frankly, because there's either a floor or the whole market shifts up or down. So again, I would encourage you and anyone that thinks about these markets to think more as what is a spread over a cycle that you can achieve over, let's say, high yield. That's probably the best proxy that you want to compare yourself against, or the leveraged loan index for if you compare that to private credit. So that is much more what matters. So if the whole market is shifting down because the Fed funds rate goes down to, I don't know, 2% or whatever, it impacts the whole market. But the spread to the public side should remain very steady. And so that is more, and it will always fluctuate over a cycle. That's why I think the across the cycle view is actually quite important. I think what we hadn't had a down cycle just yet, quite frankly. That is something that I have seen a few myself. So I think investors haven't experienced that and only a glimpse of it. If you think of the last couple of years, I would encourage everyone to think more in longer term cycles as opposed to like 12 months. So this is an important piece. And the related to that is think in spread over the public side that you want to achieve, but because that also should impact how advisors think about portfolio construction. So what's my risk budget and how do I achieve a higher return given a certain level of risk in my portfolio to my clients? The one thing I cannot emphasize enough is this sounds all great. Obviously, we're doing this, so I'm a big proponent of it. And it's a big but, advisors need to take the time to really explain to their clients what are they getting themselves into. And that's the thing that we really make sure that advisors truly understand what it is that they are investing. What is private credit as an asset class? How should people think about liquidity? Different fund structures offer different liquidity terms. Understanding that, and that's the first thing. The advisors need to understand it. And if the advisors get it, then they can explain it to their clients. So advisor education is really extremely important. And from there, you can then talk about portfolio construction and the impact of, let's say, a semi-liquid structure has on the overall liquidity of a portfolio. That is, it doesn't matter until you want to get out. And then it
Yeah.
matters. So people need to understand that if it's called a semi-liquid structure, it should be viewed as a illiquid structure. And in fact, quite frankly, that is precisely what we get paid for. We get paid to provide access to inherently illiquid loans for which we get paid, and complexity for which we get paid a certain premium. You can't have it both ways. And that's a very important educational piece that every conversation we're having with advisors, we want to make sure that they truly understand it.
Robert, I'm so glad you brought that up. I am a firm believer of education, especially now. There's so many complex products out there, especially like on the ETF side, all the innovation there and the option overlays and stuff. Last thing you want to do as a financial advisor is one of those products blow up and not benefiting your client, calls the next day wondering what happened. And you got to explain to yourself. It's very complex right now. It's just not buying an old school mutual fund or a SP with a spider. So I'm really glad you brought that up. Education in this space. Do you think, and we talk a lot about private equity and being illiquid or semi illiquid, and a lot of investors, when they look at investing in equities, it's a very fluid market. You can buy, sell throughout the day. Private equities on the opposite end of that. Bonds is, you think, it's a longer term investment, hold till maturity, or you should. So do you think that conversation's easier when you're talking about credit, saying longer term, it's illiquid, you want to hold till the exit? You think that's a little bit easier conversation on private credit versus like private equity?
It's less about the conversation. I think obviously in private credit, it's an income oriented product. So you provide a regular stream of income, like a dividend yield. That is obviously different if you have a venture fund, a growth equity fund, or a private equity fund. So I think very important is you need to start with what's the client need and what's the investment strategy that we would like to offer to a client and what is the match. And only then at the very last piece, you come to the point around, okay, what if we want to target this investor base with this strategy, what is the right vehicle? That is actually the very last piece that you should think about. You should really start with who are the clients that we want to target? What is the investment strategy? What is the merit? What's the illiquid nature of the underlying investments? And then, therefore, if you put one and two together, what is the right vehicle structure? So I would make the argument, sort of anything credit oriented lends itself more to structures that provide more frequent liquidity. But again, that shouldn't be viewed as, oh, because it's more frequent liquidity, it's liquid. It's not. However, it's give and take, right? So the private credit fund offers typically quarterly distribution. So you get some income. And then at the same time, it should offer its investors an opportunity to redeem. And that is very different. So there's liquidity coming into the fund and out of the fund. And it seems like that sounds fair. You know what I mean? Because the underlying loans provide that stream of income. That is very different. And by the way, you are not paid for shooting the lights out. Like we have the highest return, or that's not what credit investing is all about.
Yeah.
Like not making mistakes, having very sound and prudent underwriting guidelines. That is what credit investing is. You are providing to the downside, so you're solving for that. Whereas if you think in terms of venture, private equity, growth equity, it's very different. You want the upside, right? It's okay if a fund has 10 investments only, highly concentrated, and 4 of them go bust. That's fine because typically only 1 or 2 investments make the whole return of the fund. But the problem with that is it can take a very long time. And in the meantime, there isn't really much of an exit. There isn't a payout stream unless you have an sort of one of the investments in the fund that gets liquidated early for whatever reason. Because of that, a quarterly liquid structure doesn't seem to make sense, And so therefore, but again, that's at a very high level. You really always need to look through what are the underlying assets and what is the right match between client needs and underlying assets. And that should then help you determine the right vehicle structure.
Robert, your segues are perfect. You're answering all my talking points here because I was going to talk about investment vehicles, but it's like you're reading my mind here. This is fantastic. One thing you talked about, the spread over public credit is one thing that private credit offers. Diversification is another. Is there anything else that private credit offers investors or adds to an investor investment portfolio that public credit doesn't?
Yeah, look, I mean, there's diversification. That's one. There is the potential for enhanced income or total return. That's the second piece. And this all comes together with lower correlation to the public markets. Last but not least, you also have some protection against inflation and interest rate movements, as we discussed, because they're floating rates and then there are floors. So those are some of the benefits that private credit can provide vis-a-vis the public markets. But again, and that's probably my main message for advisors, you always have to view this in the total context of the portfolio of any given client. And every client is different and have different sort of risk tolerance levels, liquidity constraints or requirements. So that's where the advisors are the experts. Where we can help is providing them with the necessary education on these markets, as well as giving them an idea of how structures that we bring to market could potentially help them enhance the overall portfolio risk-adjusted returns, because that's essentially lower volatility typically leads to higher Sharpe ratios at the end of the day. And that is something that advisors just need to be aware of. But it also comes at a price, and that is less liquidity. And that is also something that advisors need to embed in their sort of portfolio construction thinking.
Robert, you know what I need is I need a bell or something. So whenever anyone says risk adjusted returns or the Sharpe ratio, ring the bell, because that's where I got the name of the podcast, Adjusted for Risk Adjusted Returns. So I love that you put that in there. A big fan of the Sharpe ratio, risk adjusted returns. And I can also tell that you do have an RIA at Nomura and you're a fiduciary because of the importance that you're talking about education and being a fiduciary and how important that is. So you can tell really where your heart is there.
Yeah, I would say one, if I may, what I like about the RA market is they're entrepreneurs and they have their client interests in their heart. They carry it every day. When we came here to build this business, yes, we're doing it inside a larger financial institution with a lot of financial backing, but quite frankly, we needed that backing to deliver what we are now providing to our clients. But it's an entrepreneurial mindset. And the entrepreneurship as a principle is actually one of our founding principles that Mr. Nomura himself 100 years ago wrote down as one of the 10 principles of how to run this firm. And that's essentially what attracted me so to it, and what also aligns our interests with those of the RAs that we're dealing with. So it's not only having the fiduciary compass and mindset always in mind, but also how you actually execute and doing that with an entrepreneurial spirit. And that is where the RA market or the RA segment and what we provide as the investment manager, who is also an RA, are perfectly aligned.
I love it. I love it. I love the history too. That 100-year history is fantastic. Happy birthday
Thank
to you all for 100 years. That's amazing, especially in this
It's
industry.
coming up soon. It tells you about religion a little bit. It is December 25th. That is when the company was founded 100 years ago, and Mr. Nomura at the time had the foresight a year later to establish the New York branch. So next year we have a second 100-year anniversary. In this case being in the U.S. for 100 years. So I'm looking forward to 100 years twice, this year and next year.
So you got 2 bottles of champagne that you can pop. I will be celebrating too. It just happens to be my anniversary. It's my birthday on Christmas Day on December 25th also. So I'll crack a bottle of champagne or wine to in both of our honors.
That's right. Maybe we
And
can do some nice sake or so, in case you like that.
hey, I can do it if we have some good sake or some good sushi and stuff too. Fantastic. Real quickly, last thing. There's been a lot of talk about private investments and alternatives and 401k plans or defined contribution plans. What's your take on that? You talk a lot about education and the importance of knowing really what you're getting yourself into with the liquidity of alternatives, private credit, private equity. What's your take on them being involved in 401ks?
Yeah, needless to say that 401ks being very long dated in nature, and we know there's early withdrawals. We know that, but it's not that withdrawals are like at an alarmingly high levels. 401k plans, target date funds, which is mostly what people invest in, have a very long dated time horizon. My target date fund is, I'm not going to disclose the number, but let's say it still feels very long dated. And so you would think that access to private markets, which are also long dated and have a long term time horizon, could actually make sense because they are illiquid in nature. And to me, that is something that logically makes a lot of sense. I think the logic argument isn't really the problem here. I think the problem is more in the sort of the angst for litigation and fiduciary duties that we already see in regular target date funds, and whether record keepers and plan sponsors adhere to the lowest cost provider, or they only went for the lowest cost but not highest performing provider. It doesn't matter. Like, people will always find arguments for class action lawsuits. So I think that, to me, is the biggest issue. The issue is not whether they deserve to be inserted into long dated vehicles such as target date funds. That is not the issue. That, to me, that goes without saying. Obviously, you need to think in fee structures, etc. It shouldn't be excessive fees. I get all of that. But quite frankly, we have that same discussion when people look at our solutions versus others, right? So fees have come down everywhere, not only on the active mutual fund side. They've also come down even more so on the passive side. And they've also come down on the alternative side. So in general, fees are moving one way, and that's definitely downhill. And it's true for all areas of investing. And that should translate itself also into the target date fund / 401k space over time. But that should be indifferent of whether they fit its purpose from a long-term asset allocation and also the return perspective. So if you can deliver higher returns on a net of fee basis, and those returns compound, I don't need to explain you and your audience on the compounding. Who said it's the
Eighth wonder of the world.
eighth wonder of the world? Exactly. Was it Albert Einstein or who said it? I can't remember.
I think it might have been.
So
Known to be wrong before. So, Robert, don't put that in stone, but yes.
my point is, rather, you get my point, right? So if
Yeah.
on a net of fee basis, right, and that is very important, and then you tell them the fee is, wait, the fee is too high. No, the point is, what do your clients get net of fees? Like, forget what the fees are. You obviously need to make your diligence, etc. But at the end of the day, what you are signing up to is a net of fee concept. That same logic should obviously also apply into the 401k space. And there, if that applies and it works, and that's exactly what we're trying to accomplish as an industry, then on top of that, the compounding effect does wonders, and that could help ease some of the retirement issues that we have. Because I read a lot about how many 401k millionaires there are, and that's great. The true reality is most 401k holders actually, when they retire, it's just not enough. And there's no social security net unless you are in the public system. So we as an industry can actually contribute to solve some of the retirement issues that this country is facing.
I love it, Robert. I really got started in this industry by being a part of a group. We're advisors to 401k plans or plan sponsors. I help do the analysis to pick the funds for the fund lineup. I think it's a fascinating subject. You brought up some really great points there, and it's something to keep an eye on. I love it. Robert, wow, that was a fantastic conversation. Thank you so much for coming on the show. Like I said, it's an honor to have you on and sharing such great insight. Where can our audience get more information about Nomura Capital Management?
If you go to nomuracapitalmanagement.com, you'll find us there. You'll find us on LinkedIn. And I would encourage everyone to reach out. We would love to chat with you, get an opportunity to learn more about what you do and whether there's an opportunity to partner.
Yeah, fantastic. And I will say, a lot of people may second guess this, but I do research before these episodes, and I went onto the website for the past couple of weeks at Nomura website. You guys do have some fantastic insight, information, asset-based lending, a lot of different, like you said, you talked about education, very important. You guys provide a lot of great education on your website. Can't recommend it enough.
Thank you so much, Ryan.
Thank you, everyone, for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to subscribe to those channels and follow us on LinkedIn. Thank you very much and have a great rest of your week.